Your investment risk profile is one thing, but your actual investments are another because real money is on the line. Now, the two are supposed to match up, but how do we do that? Well, let's see. Hi, and welcome back to the channel. My name is Pete Matthew, and I'm a chartered financial planner based in the UK. And last time, I talked about a concept called risk flex. I'll put a link in the description to that video. The principle of risk flex is basically that with your own risk profile as a starting point, you should flex that up or down depending on the time scale for your investments. And risk, when it comes down to how your investments are constructed, comes down to the level of equities or shares in your portfolio. And for our purposes today, I'm going to say that cautious is around 40% in equities, balanced is up to 60% in equities, growth is up to 80%, and adventurous is up to 100% invested in equities. Now, how does all this work in practice? Well, let's start simple, shall we? From last time, we have a ladder of timescales. I'll put these up the side here. They are 1 to 2 years, 3 to 5 years, 6 to 10 years, and 11 or more years. Now, your personal risk profile should always be at the 6 to 10 years rung of the ladder. That's the sort of medium to long term. The bottom rung of the ladder, which is 1 to 2 years, is always held in cash. That's just too short a timescale to invest over. So let's say you're a balanced investor. Now, I would define that, as I've said, someone invested roughly 50 to 60% in global equities, with the rest in bonds, property, and other stuff. Now, let's say you're 36 years old, and the pot of money we're talking about is your pension, which, of course, you can't access for at least 22 years. So your pension pot falls at the very top rung of the ladder, and so you should invest it on what I would call a growth basis, up to 80% in shares. That's higher than your standard balanced risk profile, but the timescale we're talking about justifies that. Now, if you had a pot of money which you thought you were going to need in, say, 4 years' time, maybe for a big holiday when you hit age 40, well, that would be a rung down on the ladder to cautious, maximum of 40% in equities. Your pot, which will be used maybe to help pay for the kids' school fees in 7 years' time, well, that should be invested as balanced. It's in that 6 to 10 year window. But if you are a growth investor with similar pots and timescales, you can invest everything with a bit more risk, like this. And that's just because your general risk profile is higher, so everything can go up a notch. But what if we have just one pot of money, one account like an ISA or a pension, which we might want to access at different timescales? Well, let's say you're retired and you have a pension fund and you're a growth investor who is drawing down £1,000 a month, say, or £12,000 a year. We'll ignore inflation for the purposes of this example, just to keep things simple. Well, I would work out what I needed to draw off the pot for each block of time, and then I would invest the pot in different approaches and in different amounts. So here, the first 2 years' worth of withdrawals, that's £24,000, should be held in cash. The next 3 years, 3 times 12, £36,000 should be balanced. The next 5 years, so years 6 to 10, amounts to £60,000, and that should be invested as growth, and then everything else in the pot above that should be invested as adventurous. Now, if you're a cautious investor, then the pots would look like this, with the first 5 years held in cash. Years 6 to 10 held as cautious, in line with your attitude to risk, and then the rest held as balanced. And this way, your risk profile is flexed by timescale, but never more than one level above. So if you're a balanced investor, you shouldn't have money invested in 100% equities, or what I would call an adventurous basis. Probably, you might not be able to handle it. Now, applying this in practice is simple enough. Either you can have an account for each risk and timescale level. So I have some clients that have one pension pot for the very long term, the 11 plus years money, and then they make transfers to another shorter term pension pot as they need to. If you are in a relationship, you could have one partner's ISA invested at one level, the other partner's ISA invested at a different level. Or you could just use different funds to demarcate the different levels in one account. I talked about choosing funds a few weeks ago, and there's a link to that video in the description as well. But I think it makes sense to keep all of this as simple as possible. Complexity can lead to a lack of willingness to engage with your finances. For many people, that's true. And if the thought of reviewing things regularly fills you with dread, then fact is you're going to need to structure things so that they don't fill you with dread. And simplifying things means that you can easily pick up where you left off last time you looked at it all. We all have different tolerances for complexity. Mine is very low, so my own portfolio is super simple. Hopefully that's helpful for you. If there's anything you'd like me to add to this whole concept of risk and timescale, let me know in the comments. I'll do my best to answer questions there, or if necessary, I'll shoot a video to address them. But if it has been helpful, please hit the like button and subscribe to the channel if you're not already. That really does help us out, so thank you in advance for that. And thank you so much for watching. I'll see you next time.